Every generation faces a system that looks unbeatable. A structure so large, so well-funded that it convinces the average person that the game is rigged. Wall Street has built that illusion for decades. That size equals power, that capital equals control, that the little guy doesn't stand a chance. But what they never tell you is this. Markets don't move because of money, they move because of belief. And belief is something no hedge fund can buy. If you've ever felt like the market is against you, remember, the market has no agenda, it's not alive, it doesn't know your name, it doesn't care about your account size. What moves it is collective behavior. Fear, greed, hesitation, confidence. And those are human traits. When you learn to see that truth, you begin to realize that the battle isn't between small and big investors. It's between disciplined and emotional ones. The average person loses not because Wall Street beats them, but because they beat themselves. They panic when they should be patient. They chase when they should observe. They doubt when they should trust their process. The market rewards emotional balance more than any balance sheet ever could. Big institutions may have billions, but they're chained by bureaucracy, regulation, and size. You, on the other hand, can pivot in seconds. You can be liquid when they're locked. You can exit in an instant while they're still unwinding positions. That's your hidden weapon, speed and freedom. You don't need to predict the market. You need to react faster than the ones who can't. Let me tell you something fundamental. You don't need to trade like Wall Street to win against Wall Street. You just need to think differently. While they focus on quarterly reports, you focus on timeless principles. While they chase performance metrics, you chase mental clarity. While they're driven by pressure, you're guided by patience. That's how the small investor wins. Through self-awareness, through mastery of mind. You see, every trade is a reflection of your inner world. When you buy, you're expressing confidence. When you sell, you're expressing fear or control. The market becomes your mirror, brutally honest, never biased. Once you understand that, you stop fighting the market and start aligning with it. And that's when the game changes. Small investors have an advantage Wall Street can't replicate. You can focus on precision instead of scale. They move billions and must tolerate imprecision. You can move thousands with perfect timing. They have to defend performance every quarter. You have only to defend your psychology every day. Success in the market is never about access. It's about awareness. It's not about predicting outcomes. It's about controlling yourself when outcomes surprise you. The reason most traders fail isn't because they lack strategy. It's because they lack consistency. Their emotions drive decisions, and emotions are expensive. If you can learn to stay calm when others are chaotic, if you can stay rational when headlines scream panic, if you can execute your plan when your pulse is racing, then you've already beaten Wall Street because you've mastered the one thing they never will: yourself. When the big funds panic, they have to explain it to investors. You just need to reset your mind and move on. That's freedom. That's power. The market rewards those who stay adaptable. The small investor who sees opportunity in volatility, not danger. That's the one who wins. Every crash, every correction, every panic is just a transfer of wealth from the emotional to the disciplined. You decide which side you stand on. Wall Street runs on systems. You run on awareness. They're efficient. You're fluid. They're constrained. You're free. And in markets, freedom always wins. You don't need billions to play this game. You need belief. You need clarity. You need patience when others demand action, and courage when others retreat. You need to understand that every trade is just a reflection of probabilities, not certainty. Once you detach from outcome, you detach from fear. When you stop trying to prove something to the market, you start to see everything it's trying to teach you. That's the evolution of a real investor. That's how a small player transforms into a master of timing and control. Remember this: Wall Street can control money, but they can't control your mindset. They can move the market temporarily, but only you decide how you interpret it. Your perception becomes your power. Your discipline becomes your defense. The moment you realize the only true opponent in this game is your own emotion, you've already won half the battle. Be small in capital, but big in conviction. Be humble in risk, but confident in process. Be patient in waiting, but precise in execution. Because the investor who learns to master patience, discipline, and detachment will outperform those with any amount of capital. That's how you beat Wall Street. Not by playing their game, but by mastering yours. You don't need to fight the system. You just need to stop fighting yourself. And once you do that, Once you become emotionally balanced, mentally focused, and financially disciplined, you'll see what very few ever see. That true power in the market doesn't come from size, it comes from psychological freedom. And that's something Wall Street can never buy. There's a truth that few investors ever come to understand. Your real edge in the market has nothing to do with capital, connections, or complex strategies. It's psychological. The difference between those who win consistently and those who barely survive is not measured by how much they know, but by how well they think. The battlefield of trading isn't on a chart, it's in your mind. Every tick, every candle, every position you take is simply a mirror reflecting what's going on inside you. You could have the best information, the most advanced tools, or even inside access to market data, and still fail if you can't manage your own impulses. Conversely, you could be an individual investor trading from your laptop with a few $1,000s and outperform. Institutions, if you learn to master yourself, the market doesn't reward knowledge, it rewards emotional discipline. It doesn't care who you are, how big your account is, or how many degrees you hold. It cares only about behavior, how you react under pressure, how you execute when uncertainty strikes, and how you recover when your plan goes wrong. The financial world is obsessed with edges. Technical edges, informational edges, algorithmic edges, but there's only one edge that endures: emotional control. Every piece of information available to you is also available to someone else. Every strategy has already been tested by thousands of others. But the one thing that no one can replicate, copy, or download is your internal state. That's where the real leverage lies. The investor who understands how to stay calm in chaos automatically gains an advantage over the majority who don't. Most traders think they lose because of bad analysis or poor timing. They don't realize they're losing because of fear. Fear of missing out, fear of loss, fear of being wrong. These fears manifest in hesitation, in premature exits, in revenge trades. Fear is the silent tax that eats your profits long before the market does. The antidote isn't courage in the Hollywood sense, it's awareness. You beat fear not by ignoring it, but by understanding its source. When you see that your reactions are driven by your need for control, you stop fighting the market and start flowing with it. The small investor has a psychological advantage that the institutions envy but can never duplicate: flexibility. You can think independently. While they are bound by committees and clients, you can move in and out of positions without moving the market itself. You can observe without pressure, act without permission, and adapt without consequence. That is freedom. And freedom is the foundation of a powerful mindset. When you rely on psychology as your edge, you stop trying to predict and start responding. You stop being obsessed with being right, focus on being consistent. You stop chasing trades and start waiting for alignment. In that quiet shift, your results begin to change. Not because the market changed, but because you did. The irony of the market is that it rewards detachment. The more emotionally attached you are to a trade, the less clearly you'll see it. The more you need to win, the more likely you are to lose. The best traders don't love or hate the market, they respect it. They see it as a field of probabilities, not certainties. They understand that each trade is just one event in a long series of outcomes, none of which defines them. The small investor who learns this truth holds more power than they realize. When you approach the market with mental balance, you transform volatility into opportunity. You stop seeing crashes as destruction and start seeing them as discounts. You stop being controlled by headlines, and you start controlling your response to them. In essence, you begin to play the game at a level most never reach, the level where emotion no longer dictates action. Consider this. Large investors spend millions on data, analytics, and research, yet they still lose billions when panic hits. Why? Because all the information in the world is useless when the human element breaks down. Institutions are made of people, and people are emotional. No matter how many layers of algorithms or models they build, the ultimate decision still comes down to human reaction. That's why markets crash, not because of numbers, but because of fear spreading faster than logic. Now imagine being the trader who doesn't flinch when fear floods the market. Imagine being the investor who sees red candles and feels curiosity, not panic. That person becomes rare, valuable, and powerful. When everyone else is reacting emotionally, you're thinking clearly. That's your edge. It's invisible, but it's real. The moment you accept that your performance is a mirror of your internal state, everything changes. Every losing trade stops being a punishment and becomes a lesson. Every winning trade stops being validation and becomes evidence of discipline. You stop judging yourself by outcomes and start evaluating yourself by process. The question shifts from "did I win?" to did I execute my plan? And when that becomes your standard, consistency follows naturally. A small investor's greatest mistake is trying to compete with Wall Street's resources. You just have to compete with your own emotional impulses. The hedge fund manager has to worry about clients' performance reports and billions of dollars that can't move quickly. You don't. You can wait, adapt, and strike when probability aligns with patience. The only battle you're fighting is the one between discipline and impulse, between patience and panic. If you can stay emotionally neutral in the market, you become unstoppable. Neutral doesn't mean emotionless, it means balanced. You can feel fear without being ruled by it, experience greed without being consumed by it. You can observe your emotional waves rise and fall while your actions remain consistent. That's true mastery. Think of trading as a mirror reflecting your beliefs about money, control, and self-worth. If you believe you need to win to feel valuable, you'll chase trades that don't fit your plan. If you believe losses define you, you'll avoid taking necessary risks. But if you believe that every trade is just data, every outcome just feedback, then nothing can shake your balance. You stop taking trades personally and start treating them professionally. The key isn't to eliminate emotion, it's to align it. Emotion is energy. When properly managed, it becomes focus. When ignored, it becomes chaos. The small investor who uses emotion as information gains insight that money can't buy. When you feel anxious before entering a trade, that's your mind warning you about uncertainty. Listen to it, but don't obey it blindly. Translate it into structure. Set risk. Define your stop. Calculate your size. Emotion, when filtered through structure, becomes intuition. The greatest traders in history all understood one thing. Success in markets is 80% psychology and 20% mechanics. The technical skills get you in the game, but the mental skills keep you there. Anyone can learn to read a chart. Few can learn to read themselves. The ones who do win, not because the market favors them, but because they stop sabotaging themselves. You can't control what the market does. You can't control when opportunity appears, but you can control how you think, how you react, and how you execute. And that control, quiet, invisible, internal, is worth more than any edge you could buy. Every time you hesitate, you're battling belief. Every time you panic sell, you're battling attachment. Every time you break your rules, you're battling impatience. But every time you stay calm under pressure, follow your plan, and execute with clarity, you are training your edge. You're building the internal resilience that Wall Street cannot replicate. Your edge isn't in the data you analyze, it's in the discipline you apply. It's not in predicting what comes next, but in managing what happens now. The professional and the amateur are separated not by knowledge, but by mindset. Professionals think in probabilities, amateurs think in absolutes. Professionals manage losses, amateurs avoid them. Professionals expect uncertainty, amateurs fear it. The difference isn't in capital, it's in psychology. When you master your emotions, you stop being reactive and start being strategic. You stop being the hunted and become the hunter. Not of profits, but of patterns, patience, and precision. The market stops being an enemy and becomes an ally. Every fluctuation becomes information, not intimidation. So if you ever feel like you're too small to compete, remember this. The market doesn't care who you are. It only reflects who you're being. You don't need to be big to be great. You just need to be disciplined enough to act from clarity, while others act from chaos. That's the edge that turns small accounts into meaningful wealth. Not overnight, but through relentless psychological refinement. The financial system rewards those who can think clearly when others can't. It punishes those who let their emotions dictate their moves. That's why the small investor who learns self-control will always have an advantage over the one who relies on prediction, luck, or complexity. You can't beat Wall Street with more money, but you can beat it with more mental strength. When institutions panic, you stay calm. When the crowd chases hype, you stay patient. When volatility strikes, you execute your plan without hesitation. That's how small investors win, not because they have more, but because they need less. Your edge is psychological, not financial. And once you understand that, once you commit to mastering your own behavior, you'll realize that the market has never been your opponent. It's been your greatest teacher. In the financial markets, the illusion of power has always been tied to size. The world is conditioned to believe that more capital equals more control, more influence, more certainty. But the truth is exactly the opposite. The bigger something gets, the less flexible it becomes. The same law that governs. Nature governs finance. The larger the structure, the slower it adapts. That's why the small investor, though often underestimated, holds a unique kind of strength: agility, the power to move, to think, to react without layers of approval or hesitation. In the market, flexibility is freedom, and freedom is everything. When you're small, you can change direction without losing momentum. You can adjust to volatility without emotional paralysis. You can shift your capital, your mindset, or your strategy within seconds. Institutions can't do that. They are prisoners of their own size. Their movements are slow, visible, and predictable. They require reports, committees, confirmation, and clearance before acting. They may have the resources, but they don't have the responsiveness. The small investor who understands this advantage doesn't envy Wall Street. He observes it, studies it, and uses it. The markets are dynamic. They never stay still, never repeat perfectly, never reward rigidity. The ones who thrive aren't the strongest or the smartest. They are the most adaptable. That's why small investors have an edge that no institution can replicate. You can pivot from strategy to strategy, from asset class to asset class, from risk on to risk off in an instant. You don't need to move billions. You just need to move yourself. Being small means you can wait. You don't need to chase every move or predict every cycle. You can sit out entire market phases without pressure. A fund manager can't do that. They're paid to be active, even when activity is dangerous. But you can step back, observe, and strike only when the probability is on your side. That patience, that ability to stay liquid while others are forced to act, becomes your invisible advantage. Flexibility isn't about doing more, it's about doing less, but with greater precision. The market punishes rigidity. The trader who insists on being right will always be wrong. The investor who can't change his mind will eventually lose it. Flexibility means understanding that no setup is sacred, no prediction permanent. You adapt because the environment demands it. The small investor can do this fluidly. You can flip your bias in seconds when evidence changes. You can acknowledge uncertainty and still operate with confidence. That's what keeps you alive in an ecosystem designed to destroy ego. Every crash, every rally, every correction rewards one type of participant, the one who adapts fastest. When markets collapse, institutions spend days liquidating positions, negotiating with risk managers, or dealing with redemption requests. You, on the other hand, can close everything with a single click. You can be 100% in cash while they're still calculating their losses. And when the storm clears, you can re-enter quietly, ahead of the crowd. That's the privilege of being small: invisibility and agility. Flexibility also means psychological fluidity, the ability to detach from your opinion, your last trade, or your ego's need to be right. Large players can't do that easily. They are tied to public narratives and quarterly expectations. Their identity is fused with performance. You, however, can remain anonymous. You can lose today, adjust tomorrow, and nobody cares. That anonymity is emotional leverage. You can learn faster because your mistakes aren't public. You can experiment without fear of judgment. You can evolve in peace. In markets, survival is everything. Profit comes second. The small investor survives by being liquid, emotionally and financially. That means you never anchor yourself to a single belief about what should happen. You don't argue with the market. You listen to it. You don't fight trends. You flow with them. Flexibility gives you psychological resilience. You stop needing the market to behave in your favor, and you start aligning with what's real. The less you resist, the less you suffer. Most investors think flexibility means constantly changing strategies, but that's not it. True flexibility is internal. It's not about chasing new tools every week. It's about staying mentally open and emotionally neutral. You can have one system, one approach, but still be flexible enough to adjust your expectations, your position, size, and your timing when the environment shifts. Flexibility doesn't mean chaos. It means fluid structure. Like a tree bending in the wind, you yield when pressure comes but never break. The big money fears volatility. The small investor should welcome it. Volatility is opportunity disguised as uncertainty. When the market swings wildly, the inflexible panic, but the flexible prepare. You can scale in slowly, buy when fear peaks and sell when greed takes over. You don't need to move size, you just need to move smart. Wall Street has to care about volume. You only need to care about precision. And let's talk about speed. Not just physical speed, but mental speed. When you're small, you can change conviction without changing your identity. You can say, "I was wrong," without destroying your reputation. You can execute on new information instantly. Institutions can't. Their moves are visible in filings, tracked by analysts, scrutinized by competitors. They have to defend every decision. You don't, you're invisible, and invisibility in the markets is priceless. Small investors often envy institutional traders for their access, but that access comes at a cost: exposure. The more people watching you, the less freedom you have to think independently. You, on the other hand, can be nimble, contrarian, and unorthodox. You can buy when others are terrified because you have nothing to lose but your ego. You can exit when others are greedy because you don't have to justify your caution. Flexibility is the ultimate form of independence. It's also emotional insurance. When you're flexible, losses don't define you because you see them as feedback, not failure. You can absorb information without resistance. You can accept change without anxiety. Most traders lose not because their strategy fails, but because their mindset does. They become rigid, emotionally invested in a narrative that no longer serves them. Flexibility dissolves that attachment. You start seeing the market, not as a battle to win, but as a rhythm to align with. Being small means you can be light, financially and mentally. You don't need to hedge dozens of positions. You don't need to manage staff or satisfy investors. You just need to manage yourself. That simplicity is your power. The fewer moving parts you have, the fewer vulnerabilities you carry. The less you own, the freer you are to move. When markets panic, liquidity vanishes. Large players are trapped by their own positions. You, however, can sidestep the collapse entirely. You can sit on cash and watch chaos unfold without fear. That's not weakness. That's mastery. Flexibility means you don't need to be in the market all the time. You participate when the odds are right, and you rest when they're not. That restraint is a weapon few possess. The market will always tempt you to overcommit, to go all in, to prove yourself, to force opportunity. But the flexible investor knows that the goal isn't constant action. It's selective precision. You don't need 10 trades a day. You need one trade done right. Flexibility allows you to wait for that alignment. It turns patience into a strategy. There's another hidden benefit to smallness: psychological agility. The smaller your operation, the easier it is to keep emotions under control. The less you risk per trade, the clearer your decisions become. When your survival doesn't depend on any single outcome, you're free to think rationally. That's where clarity emerges. Large investors, burdened by the weight of billions, can't afford to feel, and yet they do. They're human. The pressure distorts perception. You, free from that weight, can think cleanly, act efficiently, and adapt instantly. The market constantly changes form. Trends, volatility, technology, sentiment. What worked yesterday might fail tomorrow. The only way to stay relevant is to evolve faster than the environment. Small investors can do this. You can shift from stocks to cash, from trading to investing, from growth to value, without bureaucracy or hesitation. That's adaptability. That's survival. Flexibility also means humility, the willingness to say, I don't know. Big institutions pretend to know everything because they have to maintain confidence. You can stay uncertain, open, curious. That humility keeps you safe. It allows you to see what others miss. The market doesn't demand that you be certain. It demands that you be responsive. Being small means you can reinvent yourself endlessly. Every mistake can be erased, every lesson applied instantly. You're not tied to a brand, a fund, or a board. You can start fresh anytime. That's what Wall Street can't do. They're too invested in appearances. Flexibility is rebirth on demand. You can fail and reemerge without noise. You can experiment, adapt, evolve, invisibly, quietly, powerfully. In truth, size is a liability when it comes to adaptability. The market favors those who can pivot fast, detach faster, and think without noise. The small investor embodies that perfectly. You are the lone hunter among herds of slow-moving giants. You don't compete on strength, you compete on speed, on silence, on subtlety. You win by not needing to be noticed. Every major shift in the market, from technology to sentiment, creates new opportunities. The large can't seize them fast enough. That's your unfair advantage. Flexibility allows you to be first in and first out. It protects you when others are trapped. It empowers you when others are paralyzed. It keeps you liquid, nimble, and ready. Remember, rigidity is ego. Flexibility is mastery. Ego says, I'm right. Mastery says, I'm aware. The ego resists change. Awareness flows with it. As a small investor, you must always choose awareness. The moment you start clinging to certainty, you lose your edge. But when you embrace the truth, that markets are living, breathing reflections of collective emotion, you stop trying to control and start adapting. And in that adaptability lies your true power. Because in a world where giants move slow and systems are heavy, the lightest, fastest, and most flexible always win. The small investor doesn't need to overpower the market, just to outlast it, outthink it, and outadapt it. Small size isn't weakness. It's stealth. It's speed. It's freedom. And in the language of markets, freedom is the ultimate form of strength. There's a myth that dominates the investing world, that money makes money, that the more capital you have, the easier it is to generate wealth. But that's only true on the surface. The deeper truth, the one almost nobody understands until they've been broken by the market and rebuilt by discipline, is that money doesn't multiply. Behavior does. Capital without consistency is chaos. Consistency without capital, however, becomes compounding in disguise. The market doesn't care about how much you start with. It cares about how long you can stay in the game. And staying in the game isn't about access, strategy, or luck. It's about rhythm. The quiet rhythm of doing the right thing again and again, even when nobody's watching, even when it feels boring, even when the results aren't immediate. That rhythm, that ability to show up with the same clarity every day, is what separates those who build wealth from those who chase it. Every successful trader or investor eventually learns that success is not an event. It's a process built from thousands of small, disciplined actions that compound quietly in the background. You can't see it day to day. It doesn't scream progress. It whispers it. But when you look back after a year, 5 years, 10 years, you realize the consistency was building a foundation far stronger than any windfall could. The beginner dreams of big wins, the professional dreams of flawless execution, because the professional knows capital amplifies consistency, but it can never replace it. You can give $1 million to someone without emotional control, and they'll lose it. You can give $1,000 to someone with discipline, and they'll multiply it. The difference isn't the money, it's the mind. Consistency is the bridge between intention and outcome. Every time you enter a trade, you're expressing your relationship with probability. If that relationship is emotional, your results will always fluctuate wildly. But if your relationship is structured, if you approach every decision with the same process, the same discipline, the same awareness, your outcomes stabilize. And when outcomes stabilize, capital naturally grows. The irony is that consistency doesn't feel exciting. It feels repetitive, mechanical, even dull. But that's the point. The market is designed to lure you away from discipline. It tempts you with volatility, with fear, with the illusion of urgency. It whispers, act now or miss out. But the consistent investor understands that markets are infinite. Opportunities never stop appearing. Missing one means nothing. Losing composure means everything. When you're consistent, you stop needing to predict the future. You no longer rely on luck or timing. You rely on execution. It regulates your emotions. It keeps you cool when others overheat. When your process becomes routine, set risk, define entry, honor stop, follow plan, emotion loses its grip. You stop overreacting to randomness. You start seeing patterns. You start trusting patience. In markets, chaos is constant. Consistency is control. Every time you deviate from your plan, you teach your subconscious that discipline is negotiable. That's the beginning of emotional drift, the silent erosion of confidence. But every time you stay consistent, even through discomfort, you strengthen mental resilience. You teach yourself that uncertainty isn't a threat. It's just part of the process. Capital can be lost and rebuilt. Consistency, once developed, becomes permanent. It's a skill that transfers to every market, every time frame, every asset. It doesn't depend on volatility, trends, or economic cycles. It depends on you. That's why it's the most valuable edge of all. Look at the market veterans, those who've survived decades of change. They all share the same trait. Discipline, not intelligence, not connections. Discipline. They trade less, think more, react slower. They know that wealth creation isn't a sprint, it's a rhythm. They've accepted boredom as a strategy. And that acceptance gives them clarity that most traders never find. Consistency is the language of mastery. Every master, in trading, in art, in sport, repeats the same fundamentals daily. They refine, adjust, perfect, but never abandon the basics. In the market, your basics are process, patience, and probability. The more you repeat them, the less emotional you become, and the less emotional you become, the more profitable you get. Capital grows exponentially, but only after consistency grows linearly. That's the paradox of progress. You grind for months or years with little visible gain, and then suddenly the curve explodes. Not because the market changed, but because your habits compounded. The market finally mirrors your internal structure. The small investor often underestimates this power because it looks too simple. Follow your plan, stay patient, trust the process. These phrases sound cliché until you realize they're the entire game. Complexity is just noise dressed as intelligence. The market doesn't reward complexity, it rewards consistency. Every time you execute your plan correctly, regardless of result, you win. You reinforce the neural pathway of discipline. You're teaching your brain to act with structure, not emotion. Over time, this builds what professionals call trading confidence. It's not arrogance, it's quiet certainty, the kind that doesn't need reassurance. You just know you'll execute well, and that's enough. Consistency doesn't just improve performance, it protects psychology. It turns the market from a source of stress into a field of probabilities. You no longer wake up anxious about outcomes because you're anchored in process. You trust yourself more than you trust prediction. That's freedom, to trade without fear, to invest without panic, to grow without greed. And here's the beautiful part. Consistency compounds even when results don't. Some days, you'll execute perfectly and still lose money. That doesn't matter, because what you're building isn't immediate profit, it's long-term stability. Each disciplined action is a deposit into your emotional capital account. Eventually, that balance becomes your real wealth. Unshakable, renewable, infinite. Capital without consistency is like water without a container. It spills, leaks, evaporates. Consistency is the vessel that holds growth in place. It keeps expansion sustainable. It ensures that when your capital increases, your psychology can handle it. Without that container, more money just amplifies mistakes. So how do you build consistency? Through structure and self-awareness. You define your process, commit to it, and measure it daily. You remove the need for excitement. You stop chasing perfect trades and start chasing perfect execution. You don't trade more, you trade better. You don't seek certainty, you seek stability. Over time, that discipline transforms you. You begin to operate like a professional, calm, calculated, emotionally balanced. You stop trying to win every trade because you understand that your edge plays out only through repetition. You stop judging yourself by single outcomes and start judging yourself by how closely you followed your system. That's when consistency turns into mastery. When the market moves violently, you'll notice something profound. You no longer react. You observe, you wait, you execute when your signal appears and stand aside when it doesn't. That calmness is rare, and it's magnetic. The market respects calm minds. The crowd runs toward chaos. You stay where structure lives, and over time, that difference compounds into wealth that lasts. The small investor who commits to consistency doesn't need luck. They don't need prediction. They don't even need high win rates. They just need repetition. Doing what works again and again through every cycle, through every emotion. The path to freedom isn't paved with capital. It's paved with discipline. Consistency is the silent multiplier that transforms small accounts into large ones, not through miracles, but through method. It's not glamorous, it's not dramatic, it's steady, it's focused, it's deliberate. And that's why it works, because in the end, the market doesn't pay the impulsive. It pays the consistent. And once you understand that, you stop asking, how much can I make? And start asking, how well can I execute? That single shift in thinking marks the true beginning of mastery, because consistency will always beat capital. Every time, every market, every cycle. In the end, the market doesn't reward the biggest, the fastest, or the loudest. It rewards the most disciplined. Small investors win not by trying to outspend Wall Street, but by outlasting it through consistency, flexibility, and emotional control. Every trade, every decision, every moment of patience builds invisible strength that money alone can't buy. Remember, your real wealth isn't in your account balance. It's in your ability to stay calm, focused, and adaptable no matter what the market does. Master yourself, and the market will follow. The market rewards that stability. It's almost unfair how powerful consistency becomes over time, not because it guarantees perfection, but because it guarantees persistence. The one who never leaves the game eventually catches every favorable wave. Most traders burn out because they mistake intensity for progress. They trade heavy, they risk big, they chase fast results, and maybe for a while they win. But without consistency, their wins are accidents, unsustainable, unpredictable, emotionally exhausting. Then comes the inevitable loss that erases it all. They blame the market, but the truth is simpler. They built speed before structure. The small investor who masters consistency will outperform anyone chasing intensity. Consistency compounds confidence. Every day you follow your plan. Even if the result is neutral or small, you reinforce the identity of someone who acts from clarity. That identity becomes unshakable. You stop doubting yourself because your process gives you certainty even when the market doesn't. Think of consistency as the thermostat of your financial psychology.